Hey, it's Tom here and welcome back to the channel. Now, this is going to be a Q&A video answering a few questions that I've collected on a community post that I put up here on YouTube just yesterday as I record this video. That is always where I collect the questions for these Q&A videos, so if you want to ask a question in a future video, just keep an eye on my community post page. You should also be able to turn notifications on for the YouTube channel so that you can see those posts that I put up as well. So we've got quite a few questions. I'm definitely not going to be able to get through all of them, but I will work through some of the top rated questions and comments first, the ones with the most thumbs up, and then I will basically just order by kind of who got there first and answer some of the questions from the very early commenters. So if you do want to get a question asked in a future video, like I say, keep an eye out for those community posts and ideally get in there as fast as possible so that you can get your questions answered on the next Q&A video. So that is the plan for this video, but before we get into that, we do have a sponsor for this one, and the sponsor of this video is Hatch. Hatch is the platform that I personally use for all of my US investing for me as a Kiwi based here in New Zealand. And in 2022, Hatch is asking you to think about what your big and small tomorrow goals look like. For me, the goal has always been financial freedom, putting a little bit away today with the aim being that I can do the things that I want to do tomorrow. Everyone's tomorrow looks different, whether you want to buy your first home, travel the world, or become financially independent. Reaching your goals starts by taking the first step. That's why I invest with Hatch, to help make my plans a reality. If you want to get started investing with Hatch, check out the first link in the description where you can get a free 20 New Zealand dollar top up when you make your first deposit of 100 New Zealand dollars or more before the 30th of June 2022. Okay, so let's get into the first question here. First question, and this is from kind of the ones with the most thumbs up, is from Ace. Hi Tom, what is your opinion on shamelessly cloning every position of super investors in the exact portfolio percentage? I'm currently developing my circle of competence, so I'm copying everything that Mohnish suggests. Yeah, that's an interesting question. I think it is one of those ones that kind of might sound good in theory, but is trickier in practice, because a portfolio is very much something that gets constructed over a long period of time in the case of many of these investors. Now, Mohnish has had quite a bit of portfolio turnover recently, and I think there are actually maybe a couple of questions on that topic in this Q&A, but you know, if an investor buys a position back in like 2010 and they've held that through to today, and the price has gone up a lot, that's a completely different prospective investment for you today versus what it was in 2010 potentially. Maybe it's equally attractive, maybe it's not. If it's gone up a lot, it's probably less likely to be as attractive as it was in 2010. And it's, you know, really hard to copy those positions straight up. And the other thing that happens is, you know, a lot of these investors are managing kind of fixed pools of capital. Maybe there's some movement up and down as new investors come in or some investors leave, particularly in the hedge fund kind of space, Mohnish being one of those people. So generally they're managing roughly fixed amounts of capital, and in order to buy something new, they have to sell something. And, you know, they might be selling something that looks really attractive to buy something that they think is even more attractive, and maybe as a more discretionary kind of individual investor, it could still make sense to kind of hold that initial investment that they are looking to sell because you understand the situation well, or maybe you're more comfortable with that than the new position. So I think there's some nuance to it. For me, I'm obviously running the Shameless Cloning portfolio kind of experiment here on the channel, and I've developed some rules around that to try and you know, account for these different nuances and make it something that I can put into practice. But shameless cloning is not something that I necessarily fully employ in my own portfolio. I really use the 13Fs as a way of sourcing ideas, then do my own work on it, get comfortable with the investments, and then potentially, you know, put them in the portfolio or maybe pass on them. When I make an investment, I want to be comfortable with putting reasonably substantial, you know, portions of my net worth into it, and I want to be able to sleep comfortably at night amidst volatility and that sort of thing. So for me, that's just the way that kind of works with my personality, and yeah, that's kind of how I go about it. But if you can copy some of the greatest investors, I don't think it's a terrible place to start, that is for sure. But yeah, there's some nuance that kind of comes along with it. So appreciate your question. Next one is from David. What do you think about Pabrai's hyperactivity these days? He's repainting the fence quite a lot. The paint doesn't even dry anymore. Yeah, that's a really good question. And it's an interesting one for me. So Pabrai's gone through this transition and strategy, I would say, over the last year or two, where initially he was trying to compound 26, buy 50-cent dollars, sell them at 90 or 100 cents on the dollar a couple of years later or 3 years later, and kind of rinse and repeat that strategy. And he's been fairly heavily influenced by Nick Sleep and the Nomad investment fund or investment partnership in the UK, where they basically ended up with 3 stocks, Amazon, Berkshire, and Costco, and they kind of held those 3 stocks for a very long time and earned very high returns doing that. And I think that's kind of where Pabrai wants to end up with some of these businesses that he can hold for a long time, but I think he's still trying to figure out what those businesses potentially look like for him. So it's a tough one. He is definitely more active than he has been in the past, and I don't quite know what to think about that, other than maybe he's just finding interesting opportunities in Turkey or elsewhere where we maybe haven't been able to get a lot of visibility on that. So yeah, I kind of agree that there is a unusually high amount of activity. I like to use Spier actually as a nice comparison to Pabrai, because often there is quite a bit of overlap between the Mohnish Pabrai portfolio and the Spier portfolio. Certainly not complete overlap, but there are a lot of mutually owned stocks. And it's very common for Pabrai to be selling things recently and Spier to continue holding. But from time to time they both sell, and that's probably where I pay more attention, to be frank. So yeah, appreciate your question. Next one is from Edison. What do you think about New Zealand, Australia housing market when interest rates start rising? Yeah, this is an interesting one. I'm kind of right in the middle of looking for a house at the moment. We've been, doing the open home thing for several weekends now, and kind of continue to do that. And we actually had a bit of a break, so we looked at quite a few houses kind of all through the second half of last year, really. And we've done, this is going to be our second kind of weekend of open homes, probably, as you're watching this video. And, the first weekend of this year was just a stark contrast in terms of people actually being at the open homes. Like, it was super quiet, which from a buyer's perspective I think is a pretty promising sign. And just anecdotally, we've seen houses move from auction to price by negotiation, or from price by negotiation to a more specific price and that sort of thing. So it seems like, yeah, definitely sales volumes have statistically, the numbers have come out, sales volumes are down significantly. We haven't seen major movements in price yet. But they certainly seem to be flattening out, and I think interest rates are a big driver for that, but also just getting approved for finance seems to be way harder than it was last year for a lot of people. So yeah, it's going to be an interesting one. Again, with any market, it's pretty impossible to predict exactly what will happen, but there's potentially some headwinds. I don't know. We'll kind of have to see how it plays out. It's a little bit like stock market investing, where I think if you find a good opportunity or a good deal, you kind of just have to take it and run with it regardless of the macro situation. And if you own it for a very long time and you're never going to realize those property gains or potential short-term losses, then I don't think it matters a huge amount, assuming you can service the debt and so on. So yeah, very interesting situation after property prices have come up a lot, but we'll just kind of have to see how that all plays out. Okay, next question here is from Yugal. Apologies if I'm butchering your name there. What is your thesis on owning Berkshire Hathaway, given Buffett has himself expressed concerns meeting the 15% hurdle rate? Yeah, so I don't personally own Berkshire. My partner owns quite a bit of Berkshire, and that investment is really just... I'm not particularly interested in investing, but I'm kind of interested in investing, but probably not going to look into a lot of individual companies. And that's a nice way to sleep at night and still earn probably pretty reasonable returns over time. So not financial advice on that front at all, but that's kind of the thesis for, I think, a lot of people really with buying Berkshire. And in terms of hurdle rate, I mean, there's a reply to your question here that the hurdle rate is closer to maybe 11%. I've kind of heard that it's 10%. When he bought the airlines, he specifically said in a Q&A session at one of the Berkshire meetings that, he bought the basket of airlines thinking he could earn, a bumpy kind of 10% a year over time. That's kind of his hurdle rate. And 10% is a very reasonable return in an environment where interest rates are extremely low, and they've got a very good track record of executing over time, and they've got, they're the best capital allocators on the planet. So I can see the thesis for owning Berkshire, hands down. I think for a lot of people it's kind of a safe option where you're likely to do well. You probably won't do spectacularly like if you'd bought it in the 60s, 70s, 80s, even 1990s. But I think it's probably one of those stocks that's it'll be hard to get a bad result. But again, do your own work on that particular situation. Okay, and let's do one more of these kind of thumbs up comments, and then we'll get into some of the people that just got onto the post really early. So this one is from Evan Coles. If you were to go to the Berkshire annual meeting, what question would you ask Warren and Charlie? Yeah, so I really want to go to the Berkshire meeting. We have some interesting travel restrictions which have made that difficult from here in New Zealand, but we seem to be potentially relaxing some of those. And I actually just realised now that I think in a previous question in this video I said I'm not a Berkshire Hathaway shareholder. I actually own one Class B share, and that is for the purpose of potentially going to the annual meeting this year. So still a few details to figure out, but fingers crossed I can make that happen. That would be an epic trip. In terms of a question that I would ask Warren and Charlie, I really don't have like a burning question that I want to ask them. They've been hugely valuable in terms of sharing knowledge for thousands and thousands of people, myself included, over a long period of time. And I don't know, I just kind of want to go for the experience. So I really don't have a good answer to your question on what I might ask them. If I did ask them something, it would probably honestly be completely unrelated to investing. I feel like I've got most of the investment lessons out of them that I can probably squeeze. Maybe I'm sure there's things I'll pick up over time as I read old letters again and that sort of stuff. But I don't know. I read a Charlie Munger biography. I think it's called Damn Right. Damn Right by Janet Lowe. It's sitting on my bookshelf back here. And they actually talked about Charlie Munger going on a fishing trip in New Zealand one time, so maybe I'd ask Charlie about that. And there's actually also a story about Warren and Charlie sinking a boat, which I don't think I've ever heard that story outside of that book, so I'd probably maybe ask them about those situations, but really don't have a lot of burning investing questions for them. Okay, so let's get into some of these really early questions on the post. So this one's from Benjamin, and I suspect there's a little typo in here, so I hope I'm interpreting your question correctly here. Benjamin, companies which rely on earnings from its rental properties will probably benefit from information. I think that is meant to say inflation. I hope I'm right there. For example, McDonald's, but how can it still be profitable with a negative shareholder equity? Is there any other metric to look for to compensate this return on invested capital, maybe? So companies that have cash flow coming off rental properties benefiting from inflation, I think that's been a reasonable bet over time. Of course, there's short periods of time where maybe interest rates are rising alongside inflation, and maybe the multiples that people are paying on the ability to generate rent on those properties is maybe shrinking. In other words, cap rates rise. That can certainly happen in the short term, but over the long term, real estate and kind of hard assets have been a very good inflation hedge. And really that's just from the ability to push rent up over time. That's kind of one component of it. The other component of it is that as we keep getting more and more inflation and the dollar becomes less and less valuable, construction costs kind of go up in nominal dollars as well. So when people are looking to analyze a particular investment property, one of the key things that people often do, particularly in commercial real estate, is they look at replacement cost. So if a building has a $1 million replacement cost and they're buying it for below that replacement cost, that can be really attractive. So as we get inflation and those replacement costs go up, that can help kind of have a bit of a floor for those real estate values as well. So it's sort of a two-pronged approach there. I guess there's the replacement costs and construction costs going up, so it makes more sense to kind of buy existing buildings, after long inflationary periods, and the ability to just increase rent and I should say actually inflate away debt if it's like a levered situation as well. So that's how they're probably benefiting from inflation. And in terms of McDonald's negative shareholder equity, that's a really common example. I've used it a couple of times here on the channel. They don't really have negative equity. They do from an accounting perspective, but that's really just because they've done a huge amount of share buybacks. And if you put $1 towards a share buyback, that will basically reduce shareholders' equity by $1 in accounting terms. So if you go and look at the balance sheet for something like McDonald's or one of the tobacco companies or anyone that's kind of bought back a lot of shares for a long time, you will see a item on their balance sheet called something like treasury stock at cost, and you'll see how big a number that is for McDonald's. I'll maybe put it up on the screen here. So that's negative shareholder equity is largely artificial in a lot of these companies. In the case of something like McDonald's, if you were to pay off all the debt and liquidate all the assets, there would be a very large positive number that could be distributed in cash to shareholders. So although the accounting sort of equity may be negative, the physical sort of liquidation value of that business will definitely be a positive number. Okay, next question here is from Nicholas Thompson. Do you resonate more with Guy Spier's investment philosophy or Mohnish Pabrai's? Certainly in the earlier days I would have said Mohnish Pabrai in a heartbeat. I think his sort of mental models of low risk, high uncertainty make a lot of sense to me. He's now transitioned more towards growth at a reasonable price, essentially, buying spawners, as he calls them. And I resonate with, I guess, both Mohnish Pabrai's on that front. The 50-cent dollars and compound 26 and so on still makes a lot of sense in my mind, and I think particularly for smaller investors you can hunt those out and they still make a lot of sense from an investment perspective, but it doesn't scale up into the hundreds of millions or billions of dollars quite as well. That's when you see a lot of these investors really switch towards better businesses. Typically with better businesses, when you get unexpected news, it tends to be more positive than it sometimes is in a 50-cent dollar, and I can definitely see how that maybe kind of eats away at people over time potentially. Again, it's why you make a basket of bets in a portfolio rather than going all in on one stock and that sort of stuff. So I resonate with both. I really appreciate Guy Spier's ability to hold businesses for a long time, and that unfortunately is a lesson he had to kind of learn the hard way with some mistakes from selling businesses like Crystal and Moody's and so on. So I kind of like both. A move in the Guy Spier portfolio in many ways is probably more meaningful to me at the moment because the Pabrai portfolio is moving around a lot. But again, I look at both. I treat investment ideas coming in the top of the funnel for me to kind of look at. I treat new ideas in both of those portfolios kind of equally, really. But there are definitely things I like more about Mohnish Pabrai and his ability to very quickly make a decision on these low risk, high uncertainty bets. And there are definitely things I like about Guy Spier in terms of being able to hold the great businesses for a long time and really allow compounding to do its thing. So let's do a couple more questions. So this one's from C-Cube. What are the stocks on your watch list right now? Are you planning to buy new or add to existing positions, seeing prices drop like crazy? I don't have a huge number of new stocks, I would say, on the watch list. Certainly I'm reanalyzing existing positions and potentially looking to add to some of those. I've talked about all of them on the channel pretty much, so you'll know most of those. And in terms of new stocks, I am starting to pay a little more attention to some of like the big tech companies like the Googles and Facebook or Meta we talked about on Punchcard a couple of weeks ago. That just kind of keeps going down, and I think I may kind of relook at Meta, particularly after watching again a Mohnish Pabrai talk with, I believe it was SumZero, which Brad Counter did a summary video on, and I think in his video you'll be able to get the link to the Pabrai and SumZero video. That one might be interesting if the price can kind of get low enough. There's definitely uncertainty around spending on, virtual reality and the metaverse and so on, but the core business is pretty incredible if you think it can survive some, barrage of competition on the attention front from the likes of TikTok and so on. So those are a couple of the newer ones on the watch list, but there's really not a whole lot of changes to the watch list. Again, it's just continuing to keep up to date on existing businesses. I feel like I've got a reasonably long watch list of companies that I've looked at for a long period of time. There are maybe some others I can mention here, but again, these are not stock tips. These are maybe just good businesses to kind of look into. I owned Domino's Pizza in Australia for a while in the very early days of my investment career. It just shot up to unbelievably high prices, and it's coming back down to earth now. I still don't think it's attractive enough for me to be super interested, but that's kind of one on the watch list. Another Australian stock is actually ARB, so if there's any four-wheel drivers watching this video, you'll be quite familiar with ARB, making bull bars and other kind of four-wheel drive accessories and things. That's pretty good business that's compounded at reasonable rates over time. But again, it's just skyrocketed in the last couple of years and maybe could be coming back to earth now. So those are maybe a couple of new ones to keep you satiated in your investment research. So let's do one more question from Luis Garcia. What effects do you think having a long period, more than a year, of flat or negative returns in the US stock market have on investing channels on YouTube? Would we see the mass disappearance of these investing guru and day trader channels, or could they still remain? Would value investing channels get more popular? Well, I hope value investing channels continue to get more popular over time for sure. It's really hard to say without actually going through this experience. If you look back to March 2020, that was one of the periods of time where my channel grew the fastest it's ever grown. It's where basically every finance channel that was around at that time, that's when they experienced the most growth. And that was a period of a lot of panic. People were suddenly very interested in finance, and there's been a lot of continued kind of carryover from that time frame as things have rocketed back. And then we've probably transitioned more towards the investing hype kind of channels in a lot of cases, or investing guru kind of channels in a lot of cases. Whether that will fall off if the market stays flat, I think it will have an impact, but it's really hard to quantify exactly how big an impact that will have. It's one that kind of time will tell. I think as a content creator, and kind of speaking from experience here, there's kind of a decision you have to make. You can either make content that you really enjoy talking about and you think will maybe help people and is kind of authentic to your investment strategy. That's what I try to stick to as much as I possibly can. And then there's just big time clickbait and video topics that get a lot of views, particularly in the short term, but they're maybe not evergreen, and there's a lot of hyperbole and just people being very dramatic in the investment space sometimes. So I'm certainly guilty of having the odd video that has a slightly clickbaity title, but I hope for the vast majority of the content it's kind of valuable, and hopefully it's kind of a rational long-term approach that is a little more evergreen. So those are all the questions that we have time for on this video. I really appreciate you asking a question if you did get a chance to do that, and I apologize if you did ask a question and I didn't get around to it. Like I say, if you want to ask a question for a future video, definitely keep an eye on those community posts and get in there as fast as humanly possible when they come out. I usually try to do these about once a month or so. So keep an eye out for those moving forward, and hopefully we can get a question of yours answered in these videos. But that's it for me for this one. If you want to check out the Hatch offer, the link will be on the screen here and down in the description below. Go get your free $20. It's literally free money when you start a new Hatch account, so that option is available if you're keen to check that one out. But that's it for me for this one, and I'll see you in the next video. Cheers.